All right, good morning. This is a special episode of Who Charted. We are coming to you from Future Proof down in Miami, South Beach especially, feeling the heat, if you get that from the song. A couple song references in today's recording. The title of today's note is Under Pressure, and hopefully you're picturing Bowie all done up 80s style, and if you don't know what I'm talking about, I cannot help you. But there were a lot of stories over the weekend and late last week about private credit. Now, I am by no means in the weeds on private credit, but as always, we pay attention to what different asset classes are doing and their impact on the equity market. And this is a little bit of a different chart. It's not the normal one we start with because I wanted to highlight the fact that we are under pressure here. You can see here now for the second week in a row and the third time in 4 weeks, the S&P 500 has closed below its 10-week moving average. And that 10-week moving average is actually now beginning to change trend itself. It is starting to go from rising to flat to actually having a slight downside bias. All of this plays out as the percentage of stocks advancing on the NYSE has fallen off a cliff. Now, generally speaking, as far as an indicator goes or something that we're looking for, ideally we want to be above the 10-week and we want to see percentage of stocks advancing above 70%, right? If we're kind of in that level, that is a healthy environment. The opposite is playing out here now. Like I said, second week in a row below the 10-week moving average, third time in the past 4. That's not something that happens very often, has not happened a lot since we've come out of the Liberation Day lows. So obviously something we want to be mindful of. Now, we have been talking for a long time, right, about what's going on in the market. The simple fact of the matter is breadth has been healthy, but the major stocks, right, the Mag 7 plus, the heavyweights are starting to weigh down now, right? When you look at groups like utilities and materials, these groups are sub 5%, in some cases sub 3% of the S&P 500 from a sector standpoint, right? If we kind of start thinking about the big stocks, right? This is the S&P 100. The S&P 100, not something we talk about a lot. It's the largest optionable stocks in the S&P 500. So probably the Mag 7, yeah, they live here, right? And what's kind of interesting is as the NYSE advanced decline line has been making new highs, that's that breadth strength that we've been talking about, this has actually been rolling over. You can see the red arrow there versus the green arrow. Now that is a non-confirmation, right? Ideally, we would want to see price confirming what's happening in breadth, right? Now, if you just look at breadth, things look great, all right? Up until last week, right? New high for the AD line. Normally that's healthy, but when the big stocks are not participating, it is hard for the market to go higher, and this really crystallizes that point. So this is actually a metric that we pay close attention to. I don't talk about it often, but yeah, the S&P 100, we want to be mindful of what that's doing, especially in light of breadth. And now let's talk about those Mag 7s. Roundhill, nice enough to give us an ETF that looks at the Mag 7, MAGS, and it traded at a new low for the year. Okay, traded at a new low for the year, below a declining 50-day moving average, below the 200-day moving average, which is still rising. So in fairness, the long-term trend is still up, but the intermediate and short-term trends are certainly down. And also, on a relative basis, okay, against the S&P 500, the Mag 7 has been lagging, right? Now, in this case, lagging is going down, right? And in some cases, going down more than the S&P 500. Remember, you can lag, right? For a long time, for a little while, we were lagging, right? We're just going up. The mags were going up. They were just going up less than the broader market or the S&P 500. Now they're going down more than, and that's played out and kind of accelerated a little bit over the course of the past week. So again, think of it as, think about somebody really small holding up an elephant, right? And that's kind of what's been playing out in the market, right? And when these Mag 7 stocks start to crack, there's going to be bigger problems despite the breadth, right? And that's what's playing out. Now let's look at our intermarket theme. Transportation stocks got absolutely throttled last week. This was one of the bright spots, right? Transportation stocks have been utterly ripping higher. Remember a couple weeks ago, we talked about the absurdity. There was some, AI company that was a threat, right? Transport's actually rebounded, and then now for 2 weeks in a row have been lower. And last week was substantially lower. Still well above the rising 27-week moving average, but that's a big move, okay? And if we start to see a breakdown in one of our key intermarket themes, that's going to make it even harder, in my opinion, for the market to sustain a bullish trajectory, especially if the mags don't get in gear. I honestly think that what we're going to see, or what we could see, odds just increase, that we could see that 27-week moving average come into play. So transports are a key intermarket theme that we want to pay attention to. And now I'm going to get a little wonky. All right, this was the story late last week, or this was part of the story late last week. Just so we're clear, an OAS is an option adjusted spread. Okay, it is the difference between high yield and treasuries, or in this case, triple C and below in treasuries. Now, high yield bonds or junk bonds are just what you know they are. Triple C and below, think of that as the junk of the junk, okay? The worst of the worst. And here's what's interesting to me. Back in the fall, we started hearing rumblings about private credit. There was a key bankruptcy. Some of the BDC companies were caught up in it, right? Subsequent to that, high yield spreads have actually come back to trade very close to their tightest levels over the past couple of years. In fact, if we look at the one-year stochastic, it's at about 16%. Think of the stochastic as a one-year stochastic of 1 means the product is trading at a one-year high, a one-year stochastic of 0 means it's trading at a one-year low. So 16 is close to the lows. Now, contrast that with the rising trend that we've seen in the triple Cs, right? They are trading in the roughly 45th percentile on their one-year stochastic. So why is this interesting? Right? Because the market is telling you that they're worried about what's happening in the worst of the worst credit rated stocks, okay? Triple C and below, like I said, is the trash of the trash, the junk of the junk. If you are a triple C company, I don't mean this to offend you, it just is what you are, okay? So we heard some stories last week about BlackRock gating one of their private credit funds, right? Not getting easy access for investors. Last month, we heard the same from Blue Owl. These stories are starting to crop up. I think there's something to pay attention to, and I think that's what's happening here. So if we think about credit as an intermarket theme, there are some signs of concern in the worst pockets of the credit market. And then finally, I will leave you with the VIX. Now, you've seen this chart before with this red box. We've shown it. We don't show it every week, but we have shown it. What's been interesting to me is that it's been drifting higher all year. Since the start of 2026, the VIX has been drifting higher. And then finally, last week, we had that big spike, right, to close just below 30. Now, as we record this at about 8:30 on Monday morning, S&P futures are down about 1.5%, 1.6%. So it wouldn't be surprising to see the VIX at least open higher on Monday morning. This is something we want to actually be mindful of because there could be potential short-term opportunities on spikes in the VIX. Not there yet, but it's interesting, right? The breadth people have been arguing forever or all year that things are fine, right? Things are fine, and they have been. But we've been arguing that if the largest weights in the index are not participating, it's hard for the index to make much progress, and that's what's playing out, right? The S&P 500 is down small on the year, but the VIX has been tipping its hand since the start of the year, drifting higher before spiking last week. So that's something we want to pay attention to. So I am going to leave it there. I'm going to go enjoy Future Proof. I have a bunch of meetings lined up. If you are here, certainly come by to the Potomac booth and say hello. And if you're not, we'll be back in studio next week. Thanks for taking the time, everyone.